I'm Sean Aylmer, and this is a Fear and Greed extended interview. All the other good bits we couldn't fit into the daily podcast. If you're looking for the daily episode of Fear and Greed, check the podcast playlist. Otherwise, enjoy the interview. The financial services sector has always been a very big part of the local market, normally around 25% of the ASX. The big four banks are all top 10 companies, and depending on the share prices on the day, the Commonwealth Bank is quite often the largest company in the country. The banks, though, have had a tough couple of years, starting with revelations in the Banking Royal Commission, heading through to 2020, where home and business loans were frozen, profit margins narrowed, and banks were forced to cut dividends. But the sector, and the big four particularly, and their strength, have held the rest of the economy in good stead, effectively acting as shock absorbers throughout the pandemic. Their share prices have bounced in recent months, and recent earnings reports have been pretty positive. To talk to us about the sector and its future, I welcome Tim Dring, Oceania Banking and Capital Markets Leader at EY. Tim, welcome to Fear and Greed.
Great, thanks for having me, Sean.
What a sector. I love the banks. They're huge.
They are a big part of the economy, as you said, very big part of the economy.
We always talk about the big four, but in the last week we've found out that I think it's the 9th and 12th largest banks, which was Bank of Queensland and Members Equity, are merging. It is quite a more diverse sector perhaps than the big four than most of us think about, Tim.
Probably has changed a little bit as far as, the market participants go. We've seen the journey that, the neobanks have been on with the announcement and potentially, the laxing of some regulations to bring new competitors to the market that APRA announced around that regime a few years ago now. We've seen the rise of non-bank lenders play a big part in the economy as well. So, that landscape is changing, and you're right, consolidation amongst some of those smaller banks outside the big four.
So I wouldn't mind going through a bunch of issues with the banks, starting with the Royal Commission. Obviously, that dominated the sector in 2019. And we don't need to re-prosecute any of that. How do you think the banks emerged from those findings? And do you think it has actually fed its way through the organisations and particularly the culture of the organisations?
Well, it's still a journey, and I think it was a big line in the sand. I think many institutions were on the journey to improve conduct and culture in the organisations, and we're still seeing that play out. There is significant investment both in processes, first line, second line staff around risk and compliance to just make sure that the banks are continuing that journey of complying with the rules and regulations, and in particular, making sure the culture is right, top down, right through to frontline staff as well. So it is a journey. I think they're well advanced on it, but there is always more to do.
I think it's easy to underestimate the new governance procedures that the banks have had to put in place in the last 18 months. They seem to have spent a lot of money and employed a lot of people trying to get things right.
Yeah, they have. You see that play out in their results where, some of those costs, particularly in relation to remediation, that's, compensating customers for errors or conduct issues, has been a big feature. That's still a big feature, but starting to taper off. But we are now seeing the ongoing cost of regulation, in particular people, as I said, in sort of first line risk functions and second line risk functions and assurance functions as well, just to make sure that they are complying with those processes. And it is difficult because many of the institutions are large and they have significant legacy systems and processes. So, to make sure they are complying is requiring a human effort to do that, a significant human effort.
Okay, now COVID-19, just can't quite remember who said it. I think it was one of the CEOs talked about the banks being the shock absorbers for the economy. And they really have done a terrific job, I think, over the last 12 months in keeping the economy stable, mostly because of their size, but also being strong enough to allow people to freeze home loans or freeze business loans and then move on. How do you think they performed over the last 12 months or so, the banks?
Yeah, look, it's a really, really good point. I think, that comment about being a shock absorber for the economy is valid. I mean, banks play a pivotal role in the economy, and they are the pillar of the economy in some ways in making sure goods and services flow and the transfer of credit. When you look at what has occurred over that period, there's been a fantastic, I think, support from government, Treasury, APRA being the banking regulator, and the institutions themselves in coming up with an approach that's really putting the economy at the forefront and really supporting customers and borrowers through this very, very tough period. Some of these measures start to wind off in the next month or so, but certainly it has provided a shock absorber for particularly small business and homeowners as well.
But of course, the people who lose out are actually the shareholders. We talk about the banks as this big corporate, but in actual fact, they're owned by literally hundreds of thousands of people who are shareholders, and their dividend journey hasn't been so good.
No, it hasn't. And, as we know, the regulator restricted the payment of dividends for the banks, and that does hurt shareholders, particularly in an era of low yields from savings accounts and so forth, so particularly retirees on fixed incomes and so forth. So that has had an impact. But there are a lot of stakeholders to manage. Sometimes you're going to keep customers and borrowers happy, potentially at the detriment of shareholders. But I think we have seen bank share prices rebound. I won't say they're back to their pre-COVID days, but they certainly are on that journey. And, I think it was a necessary measure to put in place and shore up the economy and really shore up the position of the banks as well.
Tim, stay with me. We'll be back in a minute. My guest this morning is Oceania Banking and Capital Markets Leader at EY, Tim Dring. How are their profit margins in this low interest rate environment?
And it's really been a journey the banks have been on for the last, we've been tracking bank results now for the last decade. And over that journey, we are seeing, bank margins fall. So that's the difference between what a bank effectively lends money for loans against the cost of borrowing that money to finance those lends. So we have seen over time that has reduced to a point now we're sort of under 2%. Now, that has put pressure on earnings, but we are seeing banks now respond because this is a low interest rate environment, Sean, and margin compression is going to be here for some time. So we're now seeing banks respond on the other side of the P&L and really focus on costs, process efficiency, digitisation to try and take some of the costs out of their business and increase their profits.
You referred to that before, but they're doing a reasonable job on that front?
Well, I think they are. And once again, it is a long journey. We've got banks that have probably underinvested in some of their systems over those years. And with the take-up of digital processes, new technologies coming to bear, the cloud, all of those sorts of things have really facilitated this digital journey that many banks are on at the moment. As I said, it is a journey, and we are seeing banks really bite off as much as they can from front office right through to back office. Now, there's some pretty big targets banks are looking to achieve to try and take costs out of the business. But when you look at what is available, and in particular the legacy bricks and mortar structures and branch structures that banks have, there is still considerable upside to take further costs out as well.
You mentioned earlier on about new players and competition. Now, the neobanks don't seem to have performed quite as well as perhaps some would have hoped. But the Apple Pays of the world, are they kind of the next frontier in terms of who's competing with the banks?
It's a really interesting question. You look at some of the famous quote, timing is everything in some ways. And when neobanks came to market, really were gathering some momentum was prior to COVID. That certainly sent them a couple of steps back in some ways. The demands on capital, the low interest rate environment, ultra low interest rate environment, it really has an impact on their business models. But then at the same time, we've seen the rise of payments and different payment platforms come to market as well. You've spoken about one in particular, but just the rise of digital payments we are seeing right across the market from some, even whether it be traditional players or non-traditional players coming to market. And I do see this expanding further, Sean, when we move to open banking later this year, where customer data will be made available by institutions. So that is now giving other institutions that may want to be data recipients further access to information to make better product propositions to customers and potential customers and access potential markets they weren't able to before.
So just sort of dumbing that down for me, open banking, the benefit of that is that it'll make it a lot easier for me, for example, to shift from one organisation to another on the back of some decision I make.
Yeah, that's right. And you, as a customer, you'll be able to make a decision, Sean, whether you want to put certain information, including transaction information, to be made available to data recipients. So whether it be banks or non-banks or even third parties and other players in the ecosystem that may want to access that information to provide you a better proposition potentially. So, there's an upside for new entrants. There's an upside for even incumbent players as well. But there's also some upside for those institutions that are making that data available, because they can also become data recipients. And I think a good, one angle out of this, Sean, is that for a customer looking to put their information out there, what is that saying about that institution's relationship with that customer? And is that something that proactively that institution might be able to tackle in a different manner, in a more proactive manner, to try and retain those customers?
We'll be back with more in a moment. I'm talking to Tim Dring, Oceania Banking and Capital Markets Leader at EY. Now, just a couple of things I'd just like to run through quickly. Responsible lending laws. The government has said it will alter responsible lending laws, which effectively puts the onus on proof of the ability to repay back on the borrower. At the moment, it is on the banks. Bank share prices jumped as a result of that. How important is that?
Look, it's going to be a really important piece of legislation should it come in and change the landscape.
It hasn't actually been legislated
No, you're right,
yet,
it
has it?
hasn't come in.
It's
right. Certainly an area that banks have really struggled with over time, and I think probably an area that regulators have struggled with over time. You're quite right that burden of proof has now been, that obligation really sits with the institution in itself, but the level of scrutiny, the level of verification, I think is one thing that institutions have really grappled with in trying to really answer the question, what is reasonable inquiry? Is that loan suitable? So therefore, it's really pushed them down a path, Sean, in some ways, of having to verify every bit of income and every bit of expense incurred for the sake of trying to do the right thing. And we've seen some of those terrible examples through the Royal Commission. So the pendulum certainly had swung too far. This proposed legislation does swing that pendulum, really puts that obligation back onto the consumer, if you like. And I think there will be heavy debate around this legislation. Is that the right way to go? Because to some extent, consumers do need saving from themselves to some extent in relation to this.
Another big issue has been wealth management, and the big four have been offloading their wealth management arms. And at the moment, before regulators is IOOF's deal to buy MLC off National Australia Bank, for example. Is that a business which you can't see them getting back into?
Yeah, they have, and you're right. And once again, that has been a journey, and it's almost just getting back to their core business, and that is borrowing and lending money. That has been a journey they've been on for some time. It looks like now we've got most of the major banks through that piece. But we have, at the same time, Sean, we've also seen the bigger banks retract out of offshore markets and larger become just really domestic players in both the Australian market and New Zealand market. So it's getting back to basics, and I think it is getting back to execution excellence as well. But having said that, we are seeing, in other jurisdictions, UK and in the US, the importance of wealth management and private banking in institutions. So I don't know, maybe I might stand here in 5 years' time and say, they're getting back into it, but potentially not in the same way. And I think with the Royal Commission and the various conflicts that existed between manufacturing and distribution, perhaps that model may change going forward, but we'll wait and see.
And just finally, do you think the PR, the public relations of the banks will be better going forward? Because they have had some horrors they've lost CEOs on the back of public relations as much as anything.
Yeah, they have. Look, I think COVID-19 has been a great example, and we have seen the banks, not only Big Four, but all banks really step up, engage proactively with their customers, as you said earlier, potentially the detriment of shareholders. Whether customers remember that, I think, is the important piece. So this is, I think, a benefit for the banks, and using opportunities like COVID-19, how you benefit from the crisis, to engage proactively with your customer. And we've seen them do that with the deferral program. I think this is a great impetus to make sure this process continues, rather than a drawdown of a loan and potentially the next time we talk to a customer is maybe when they're changing banks or looking to pay out their loan. So there are so many touch points that banks can gather for the life cycle of a customer that potentially then can now harness going forward.
Tim, thanks for talking to Fear and Greed.
Great to be with you, Sean. Thanks.
That was Tim Dring, Oceania Banking and Capital Markets Leader at EY.